Hi there, I'm John Paul DiGiori, and I'm here to say welcome to Taking Stock, a great show at the New York Stock Exchange.
Einstein of Wall Street himself. How lucky am I? Peter Tuchman, oh, look at this. We were in positive territory for the S&P all day, right into the close. So what do you see in the closing book that helps explain?
We have been to buy all day, so there is definitely a buy interest, but the sellers seem a little more aggressive. I mean, it's just a choppy day. It's really hard to get a sense of it, what's going on. Obviously, over the weekend, there was more negative, narrative about what's going on in the Middle East and stuff like that. I think people are really sort of they're in the corridor, waiting for the next tranche of earnings to come out, and people are not really clear where to go. I mean, it's foundational in a way. I mean, it seems like the buyers are patient, they're letting them come to them, right? But it's just, it's choppy, and there's nothing wrong with that.
Yeah, we'll hear from Alphabet, we'll hear from Tesla. These are some of the most consolidated, most important names in the S&P 500. As they go, the broader market may for the most part, follow.
And then we've got all of, how they broke down Mag 7 into compute and chip, and so suddenly it's now a five-sector inside of a sector.
Yeah.
Right. That's kind of funny. So, I think they're just trying to determine what's going to move the market next.
Yeah.
And we're not sure. I'm going to go with I don't know today.
Yeah.
A slightly choppy I don't know.
Well, I hope you come back tomorrow, because I hope our I don't knows turn into we definitely know.
Two I don't knows.
Thank you as always, GMO. Time now for the closing bell. There you go. All right, your final tail of the tape on this Monday, it's already July 20th. Every time I come back into a Monday, I'm like, wait, it's another 3 days later. The S&P 500 in the red on this Monday afternoon, 0.2%. The Dow 30 down 0.6. The New York Stock Exchange Composite Index in the red 0.6. And the small caps, Russell 2000, the hardest hit of the major market indexes in the red. Let's call it 0.7%. Oil prices rising, not a big dramatic move, but we did have the president promise retaliation against Iran as strikes continue in the Middle East. Energy, tech, telecom, the strongest sectors in the S&P 500. A few laggards of note as well: materials, healthcare stocks, and industrials. The hardest hit. To the Dow we go. Microsoft, Salesforce, Alphabet. Those are your Dow outperformers. Pretty good day for a lot of these mega cap tech names, all things considered. Your Dow laggards: Boeing, Merck, and Sherwin-Williams. Also catching a bid, airline stocks, oil and energy names. A bit of a software bounce back we've been looking for throughout last week. Similar story for semiconductors and memory stocks, all catching a bid on this Monday as well. Let's bring in our good friend, Ted Thatcher, founder and president of Bright Lake Wealth Management. My man, thank you for being here as always.
Always good to see you.
So I want your take so far on what we've seen for earnings season, because better than expected. I feel like that oftentimes happens, right? I mean, they set the bar down here and then they clear it. But muted reactions. GE, UNH, Micron, so they beat, but the market is saying maybe you didn't beat enough. What are you seeing so far?
It's really interesting, to your point, set expectations, beat expectations, and then sell-offs. We're seeing this sort of consistently. When it comes to the big names, though, I want to see what Google does on Wednesday. As a leader, so much has been made of the CapEx spend. Are we going to get the ROI on all this CapEx? I want to see them come in with a greater than 60% year-over-year growth in the cloud business, and of course on the AI infrastructure business. 22 billion plus we expect. I think that that's going to be an indicator for whether or not they're able to turn all that compute demand, of course, into real revenue.
What else are you going to be looking for out of these tech earnings? Because we talked so much about the so-called Mag 7, although we're having a new conversation as to whether or not we actually need a new acronym, a new basket of tech stocks. But we get a few of them. It's not just Alphabet this week, but it's going to be Tesla as well.
Sure. So much of Tesla specifically, it feels like they're placing the burden on the Optimus build out. Everything that has to do with the robotics. They're not going to produce, I think, yet the revenue in that sector, JD. They have a really good run rate, 480,000 delivered vehicles, really nice year-over-year number, but I want to see the take-up that they've gotten on FSD and autopilot, and of course the robotaxi business there.
I want your take on the second half outlook because
Yeah.
we are at this point. We're a couple trading weeks into Q3. We have some sense of what the month of July is going to look like for the major market indexes. But I think a lot of people are surprised at just how strong the first half of 2026 was. What's on your bingo card for the second half?
You know, it's interesting the way the first half of this year has played out. I think a lot of people were saying, hey, we're going to get good earnings, coming into the first half of the year, and we have seen that. But what has also driven, of course, the market up is the semis, the memory, the chip names. In a huge, I would say, bifurcation to what has led the market since 2022, which is the Mag 7 names. So I think that there's actually an opportunity here for the sort of baton to get picked back up by some of those big tech names in the second half of the year. I do think it's going to come down to how they handle the overspend narrative that they've been fighting year to date. But fundamentally, from a cost standpoint, coming into this year, the S&P was trading, we were expecting about a 19.4 times earnings multiple. After the earnings per share expectation changes, we're actually trading below that number, 18.4, and so that's why fundamentally I'm constructive about the second half of the year.
I want your take on oil as well, because
Yeah.
we've been reminded in recent weeks we are not out of the woods as it pertains to the conflict in the Middle East. The White House says one thing, the White House then kind of says something else. Power brokers involved in the situation say a third thing. For the most part, kind of a muted reaction from oil, but it has moved up steadily the last couple of weeks.
It's interesting how tired the markets have kind of gotten with the war in Iran. But the truth is as long as this conflict is kinetic, the markets have to pay attention. We're seeing that reflected in the price of oil. Brent at 88, I think it spiked above 90 when it opened yesterday. And so I don't think we're going to stay here for very long. This war is not popular with Americans at all. But until we see some more light at the end of the tunnel, the markets have to pay attention.
The great Ted Thatcher, founder, president, Bright Lake Wealth Management. My man, come back to the show anytime. Good to see you.
Thanks.
All right, Robbie will grab your mic. Howard, you and I will go this way. Here are a few of the top analyst calls that moved the tape this morning here on Wall Street. First up, Goldman Sachs upgrading Urban Outfitters to a buy rating from neutral, saying it sees profit improvement. 12-month price target on the stock, $93 a share. Next up, Deutsche Bank downgrading Monster Beverage. Yeah, Monster Beverage to a hold, largely on valuation concerns after recent outperformance. Shares actually in the green for Monster Beverage, 27% year to date. Finally, Cantor Fitzgerald reiterating Tesla as overweight. They say we are sticking with the stock ahead of earnings later on this week. The firm looking for updates on robotaxi and cybercab as high margin SaaS plays for Tesla. All right, Howard, take a look at these two stocks. We'll start with AMC. Wow, hello, 26% on the day, jumped in pre-market and obviously jumped in the trading session after a big beat on earnings. The company says almost 4.5 million people saw The Odyssey over the weekend at an AMC theater. It is trading back to the levels. I mean, it's a big pop today, but to be fair, it's a $2.46 stock. It's trading back to where it was around June 16th. Shares are up in the green year to date, however, 52%. Howie, let's take a look here at Harley Davidson, ticker symbol HOG, H-O-G. You gotta love it. Up almost 5% on the day today. Loop analyst upgrading the stock to a buy, setting a new price target at $32 a share after their latest conversations with Harley dealers gave them increased confidence. Shares up 4.6% today, up 29% since the start of 2026. Last week on the J.D. Durkin Show, the only live independent show that broadcasts every week from the trading floor of the New York Stock Exchange, Lindsay Bell made the case for why she says this bull market may still have more room left to run. Take a look. S&P 500 earnings on pace to grow almost 25% this year after 13% growth last year. Historic earnings boom. What's driving it?
Yeah, I mean, this is crazy. What we're seeing this earnings season, actually over the last 6 quarters, is a magnitude of beat of almost 8.5 percentage points. And the crazy part is that we're seeing those beats as numbers move up through the quarter. I've been studying earnings for most of my career, and what I could tell you is it is normal for analysts to cut estimates as the quarter progresses. What we've been seeing this quarter, last quarter, is that numbers have moved higher going into the reporting period. Usually we like to lower them, let the companies beat the lowered bar, and the stocks can move higher. So what does that mean? The bar, it has been higher, and it's going to be higher for this quarter. This morning alone, you're seeing Taiwan Semi, you're seeing GE Aerospace. Both of these stocks beat and raised, but they're down this morning. And that's because the bar has been higher, especially in sectors like technology, energy, materials. So that's where it's going to be tough. And you're also seeing the stock responses in the tech sector to be negative this quarter. So usually the market does best when expectations have been lowered, but they have been higher. So it could be a rocky reporting period, even though we're probably going to get pretty good numbers, is my opinion.
I mean, I want to call it quite a falling knife because that's needlessly dramatic, but Taiwan Semi's chart now down for what looks like 6th or 7th days in a row. Obviously, it's coming off very elevated levels. Looks like it reached its recent high around Tuesday, June 30th, but since then, it's been a fundamentally different story, and that involves earnings. What could derail the earnings story, Lindsay Bell?
I think it's simply put is the high expectations. I mean, look at Samsung just last week. It fell 19-20%, even though it had a great earnings report. Expectations are that the type of growth, especially with semiconductors, which by the way is over 100% for the quarter and for the year, is going to continue. If there is any sign that even moderates slightly, which is why I'm worried the first chart when we saw the semiconductor stuff and we talked about peak pricing, because if there's any wiggle in that to moderate a bit, investors aren't going to be pleased with that. And so I think that we need to just be aware of where the high expectations are, but also where the low expectations are. We've seen estimates reduced quite substantially for the healthcare space and also within the consumer space. So whether it's discretionary or staples, there might be some better opportunity there this earnings season. Because again, I do think the numbers are going to be good.
I like pulling in non-intuitive parts of the general market conversation, which leads me to chart 3. I love this. Let's talk inflation rate and what it means for equity return. This is so cool. Historically, markets have posted some of their strongest forward returns when inflation has maybe been a Goldilocks zone, let's say 2, 3, maybe 2 to 4% overall. You think investors are worrying a bit too much about modestly elevated inflation right now?
Right, exactly. If you look at this chart, what it tells you is that the stock market can perform very well when inflation is in the 2 to 4% range. It really just gets rocky when we get to the 6% range, which is what we saw in 2022 and the market retreated. So we're kind of in the sweet spot so long as economic growth, what the chart doesn't show you is so long as economic growth keeps up and outpaces that inflation. Now, that being said, I do think inflation is going to be it's going to add volatility to the market because I don't see inflation returning to the 2% Fed target rate anytime soon. So the Fed's going to have to make a decision. Do we raise rates? The 2 years already at 4.5%, which is way above their target range of 3.5 and 3 to 3.75. But I think that, we are seeing deflation in some categories, which the bulls will point to, but they're in discretionary categories. We don't want to see deflation in discretionary categories. There was an article on CNBC this morning about people buying less groceries because of inflation. We want to be in the sweet spot where inflation is rising steadily, and that 2%.
Time now for a few headlines in the world of fintech, crypto, and artificial intelligence you need to know for your Monday afternoon. At this hour, the crypto majors all in positive territory. Solana, the outperformer, up 3% as Bitcoin holds on right about to 65,000. Next up, U.S. spot Bitcoin ETFs posting a second consecutive week of net inflows, adding nearly $76 million, and in doing so, fueling hopes the crypto market may be finding a bottom. Finally, a new Broadridge survey finding 84% of financial firms now view tokenization as a strategic priority, with Wall Street betting digital and traditional assets will coexist in a world of hybrid markets. In this, third and final part of this episode of NYC Innovates, Cheddar's very own Chris Castellino finishes his exploration of New York City's first robot store. This is awesome. Take a look.
The ambitions for what these robots can do also extends into commerce.
As robots interact with people in a retail setting, there may be situations where you're going to want to pay by tapping the head of the robot with your credit card, for example, or the robot itself may want to go to the store and buy a croissant for you. And of course, it can't just go to the store and steal croissants, it has to pay for them. And this means that as this technology matures, it's going to be important to imagine how robots interact with payment infrastructure.
One of the most visually striking robots in the store belonged to Chinese company AGBot, maker of the X2 Ultra, a full humanoid that can dance, move autonomously, and generate its own choreography on the fly. This is powered by their Generative Control Foundation model, which enables the robots to convert text, audio, or video inputs into real-time dynamic dance moves and improvised motions. AGBot produced its 10,000th humanoid robot in late March of this year, scaling from 1,000 units in 2025 to 10,000 units within months. Its production models are priced around $40,000 to $50,000 and up, and available for both business and consumer purchase. Which brings us back to the central question of the store. Who actually buys one of these?
If you're someone who grew up reading Asimov and iRobot and watching Space Odyssey, then it doesn't take much. You simply see one and you want one. Typically what we see is that every single kid wants their parents to buy a robotic dog. When you buy your robot, you get to name it. You're going to be the new robot parent, and it's going to remember what you told it. It's going to learn about your space. And the very first thing it's going to learn is where its charging chair is, because that's where the robot will need to go to charge himself or herself. So expect a box to arrive. One of our engineers will also drop by. We will test your Wi-Fi to make sure you have really good Wi-Fi. We'll open the box, we'll set up the auto charging, and then your new companion or helper will explore your home or your office or your workplace. And once the robot understands the space, then we'll start to help people and provide all the services that we've built in.
Every major technology shift has had a retail moment. A moment when it stops being something the experts talk about and starts being something that people buy. The iPhone had it, electric cars had it, and today on Lafayette Street in Soho, humanoid robots might have just had theirs. So tell us, which robot from the store would you bring home? Let us know in the comments below. For Cheddar, I'm Chris Castellino.
Hey now, welcome back to this Monday edition of Taking Stock live from the trading floor of the New York Stock Exchange. Lane Castleman joins me now, the co-CEO at blockchain.com. Lane, it's great to have your perspective here on the show. People are wondering, have we seen the bottom of the ongoing crypto bear market? Right around 65K for BTC, down 25% on the year, down 48% from where pricing was in early October. What do you think, Lane?
Well, thanks so much for having me. And I should note, I don't have a crystal ball. So I don't know when we're at the top or the bottom. But I can tell you, sentiment is feeling much better now than it has felt in a long time. I think we're seeing a lot of reaction to all the conversation going on in DC about clarity and just the recent market movements by some of the major companies in the space and investors. Feels like a good moment to be getting back into crypto and thinking about it intentionally.
So you mentioned the Clarity Act. Lane, anyone who's been watching the show knows we've been giving our viewers updates on it seemingly by the day all year long. What is your latest read, and how likely is it to actually pass before the November midterms?
My gosh, this act seems to be changing every day, one direction or another. But one thing is certain, and that is we have the most crypto-friendly bipartisan Congress in history. And I think there's something to be said for the commitment we've received across the entire industry from elected officials in every state and every corner of the country to really make sure we have clarity, because that's all the crypto industry is asking for, a permanent regulatory framework. So I think we'll see some real decisive action. Hopefully we see it before the midterms, but if not, I know it'll get done.
Lane, is there one part in particular of the Clarity Act you are most bullish on? What part of it, if and when it does pass and works its way onto the desk of the president, do you think, at long last, we will have accomplished that thing?
I think clear rules between the CFTC and the SEC is really what we're waiting for. Of course, in this administration, it's pretty clear how the rules are separated out between the two agencies, but the future is long and crypto is here to stay. So we want to make sure those rules are enshrined for all future administrations. And whether there's one party in power over another, we want a level playing field and one that we know how to plan for well in advance. So I think the CFTC being on the leading edge of crypto regulation probably makes the most sense for us and the thing that I'm most excited about.
Lane, I need your take on perps, because if you work in the fintech space, you're not going very far over the course of your workday without coming across a perps-related headline. What is your read on this rise of perpetual futures and what it means for, I guess, for both for the industry as well as would-be users out there?
It really does seem like every day there's something new being announced about perps from one of the leading major crypto companies, and that's a good thing. I think if you step back a little bit, what you're seeing is finally the intersection of traditional finance or TradFi and crypto, and the industry realizing that there's a lot that we can learn from TradFi, and sometimes we can do it a little bit faster, maybe a little bit better, and I think that's what you're seeing happen with perps. It really is an amazing product to offer our customers, and we're seeing a lot of uptick from not just customers that you traditionally expect to be in the space, but newcomers who want to learn more about how to invest in finance, and they find it more approachable to do it through crypto.
How are you thinking about the rise of prediction markets more broadly?
So the prediction market space has been super interesting for us. Outside the US, we launched something called Snap Markets, which are short markets that allow you to invest and bet on things as fun as the price of Bitcoin going up or down on a 30-second market. We have a lot of new products like that we're launching, and that's our take on prediction markets. But look, I think consumers are really driving the direction here. And they've said that they want the opportunity to invest in things that are happening on any given moment and any given day. I think some of the predictions that come out of prediction markets are a little off base. I think last week or the week before, there were some predictions leading about whether or not we'd have an alien reveal announcement coming out of the White House. And that was one of the number one investment prediction markets out there. So some of them aren't necessarily totally relevant to what's happening in reality, but I think it's a really exciting product and a market neutral product to be offering to consumers. And we're seeing a lot of excitement for it, not just in the US, but blockchain.com operates in over 100 countries. And we're seeing the excitement in a lot of countries around the world for something new.
Lane, I for one am, we got to leave the interview there. I for one am looking forward to the announcement of aliens landing, if and when that happens. Lane Castleman, co-CEO, blockchain.com. Thanks for joining us. Do it again soon. Folks, don't go anywhere. A lot more taking stock on this Monday afternoon coming up right after this. Oh, hey there. Welcome back to the show. Time now for the latest headlines in the world of startups, raises, and rounds. First up, British startup Cusp AI raising $450 million from investors, including Jeff Bezos' fund, to use AI to discover new semiconductor materials. Next up, Jersey Mike's and its shareholders looking to raise up to $1.09 billion in an NYSE IPO under the ticker symbol JMKE, valuing the sandwich chain at nearly $8 billion. Finally, Samsung Biologics acquiring Switzerland's Polypeptide Group. It's a $1.8 billion all-cash deal as demand for peptide-based drugs, including GLP-1 obesity treatments, continues to grow. Money 2020's very own Scarlett Sieber is back with Jargon Translator, where she puts complicated finance terminology into language anyone can understand. Take a look.
I'm Scarlett Sieber from Money 2020, and this is Jargon Translator, where we break down the terms driving market moves long before the earnings change. Today's term is multiple expansion versus multiple compression. This is one of the most understood forces in markets because it has nothing to do with what a company earns and everything to do with what investors are willing to pay for those earnings. A multiple is simply a valuation ratio. Whether it be price to earnings, price to sales, any shortcut investors use to value future cash flows. So multiple expansion happens when investors decide a company deserves a higher valuation for the same earnings. Multiple compression is the opposite. The business can be fine, but the price people are willing to pay, that drops. So here's the key point here. A stock can go up even if profits don't change, and it can go down even if the company performs well. Well, why is that? Because valuation is a confidence story. Multiple expansion happens when capital feels cheap, growth feels durable, and risk, it feels distant. On the other side, multiple compression happens when rates rise, uncertainty increases, and investors demand proof instead of promises. That is why entire sectors can reprice at once, even without bad news. So let's fast forward to today. Much of the volatility people attribute to sentiment is actually multiple compression playing out in real time. Growth expectations haven't vanished, but the price of risk, well, it's gone up. Multiple expansion and compression explain why markets feel disconnected from fundamentals until suddenly they don't. Valuation isn't just math. It's a collective agreement about the future, and that agreement changes faster than earnings ever could. With that, that is your Jargon Translated. If there's a market term you keep hearing about but don't quite trust, put it in the comments and it might just make the cut. In the meantime, back over to you.
Thanks for watching this Monday edition of Taking Stock. Tomorrow here on Wall Street, the latest quarterly results from D.R. Horton, GM, 3M, Alaska Airlines, Capital One, and many others. Have a great Monday night. We'll see you again tomorrow from the New York Stock Exchange.